This chart looks at the various adjustments that we've talked about in this chapter, what the adjusting entry looks like, and the problems that we would have in the financial statements if we didn't perform the adjusting entry. So our deferrals are a deferral of expense and a deferral of revenue. So this is when we have paid or received cash before our expense or our revenue is recognized. These are our unearned revenue, our prepaid insurance expense, prepaid rent, depreciation, etc. In accruals, we have paid or received cash after the expense or the revenue is recognized. This is when we need to accrue that we owe wages that are going to be paid at a date in another month. After we have recorded our adjusting entries, we will prepare what is called an adjusted trial balance. So here we have side by side in an Excel spreadsheet our unadjusted trial balance. Then like we prepared in chapter 2, we prepared a trial balance just to make sure that our debits equal our credits before we move forward. Then we make adjusting entries for the end of the month. So every adjusting entry we've talked about in this PowerPoint slide is shown on here. We then do the adjusted trial balance. And we can see that we've made changes based on our adjusting entries. After we've prepared the adjusted trial balance, we can prepare our financial statements just like we did in chapter 2. We would prepare the statement of cash flows, which we aren't going to do until chapter 12. But the other 3 statements, the income statement, the statement of retained earnings, and the balance sheet, will be prepared very similar to how they are in chapter 2. We are going to create a few changes to the balance sheet in this chapter. So we have examples of those balance sheet, statement of retained earnings, and the income statement from our adjusted trial balance. After we create our financial statements for the period, then we would prepare closing entries. Closing entries it's the very last thing that happens in our accounting cycle, where we close out our revenue and expense accounts to prepare those accounts for the next accounting period. That meets the revenue recognition and the matching principle by having our expenses, revenue, and dividend accounts be fresh or empty for each subsequent accounting period. Therefore, we aren't mixing revenue and expenses from different accounting periods together. So we identify which accounts are going to be closed. Those accounts are revenues, expenses, and dividends. We then record and post closing entries, and then we prepare a post-closing trial balance. Once our post-closing trial balance should only have the same accounts on it that are shown on our balance sheet. So here we have the classification, the difference between temporary accounts and permanent accounts. Our assets, liabilities, and equity, our balance sheet accounts, are permanent accounts. We leave those balances in there and we make changes to them every accounting period, but we never close one of those permanent accounts. The temporary accounts are income statement accounts. Those are our revenues, expenses, and then from the statement of retained earnings, any dividend payments that we have made. We close those all to an account called income summary. Once we've closed revenue, expenses, and dividends, we then close the income summary account to retained earnings. The amount that is in the income summary account after we post our closing entries of revenues and expenses should match what our net income is on our income statement. So we close the credit balances and revenue accounts by debiting revenue and crediting income summary. We close all of our expense accounts by crediting the expense accounts and debiting income summary. We then close the income summary account to retained earnings and then close the dividend account to retained earnings. We show what the T accounts look like here. So we have our expense accounts, which we close all to income summary. We have our revenue account, which we close to income summary. We have two different kinds of revenue, consulting and rental. We end up with a balance in income summary of $3,785. That should match what the net income was on our income statement. We close that account to retained earnings, and then we close dividends to retained earnings. The change in retained earnings should be reflective of what our statement of retained earnings shows. Then we do the post-closing trial balance. This is a list of our permanent accounts and their balances after posting closing entries. The total debits and credits must be equal after we finish closing. And remember, those permanent accounts were our balance sheet accounts, assets, liabilities, and equity. An example of the post-closing trial balance is here. When we do all of that, that gives us our accounting cycle. So in Chapter 2, we analyzed transactions, we journaled, we posted, and we prepared an unadjusted trial balance. In this chapter, we post adjusting entries, we prepare an adjusted trial balance, then we prepare financial statements. So from Chapter 2 to Chapter 3, we've added 3 steps before the financial statement preparation. And then we close the books and prepare for the next period, where we start everything all over again. Now we're going to look at a classified balance sheet. In a classified balance sheet, we classify whether our assets and liabilities are current, non-current, which is also called long-term. So current items are expected to come due or be owed within the longer of 1 year or the company's normal operating cycle. Most companies have a 1-year operating cycle. There are some exceptions to that have a longer than 1-year operating cycle. So most companies use a 1-year period in deciding what assets and liabilities are current. Our current assets are expected to be sold, collected, or used within 1 year of the company's operating cycle. Our current assets include cash and accounts receivable. Our long-term investments are expected to be held for more than 1 year or the operating cycle. These are items, can be items like notes receivable. And then our plant assets. Plant assets are our property, plant, and equipment that we use to conduct our business. The items that go in plant assets are equipment, building, land. And then the last category is intangible assets. Intangible assets are long-term assets that have no physical form, which is why they're called intangible, because they can't be touched like our building and equipment are. What is covered under intangible assets are trademarks and patents. We will talk about intangible assets in a further chapter. Current liabilities are liabilities due within the longer of 1 year or the company's operating cycle. Examples of current liabilities are accounts payable, salaries payable, interest payable. Long-term liabilities take longer than 1 year to pay, or are going to be on our books for longer than 1 year. An example of a long-term liability would be if we have a mortgage on our building, or we have a notes payable that we have taken out a bank loan to pay for a piece of equipment. Those are generally longer than 1 year. They're long-term liabilities. And then last is our equity account. Equity is our common stock and our retained earnings. The last thing that we cover in Chapter 3 is using an Excel worksheet to keep track of our adjusting entries, financial statements, and closing entries. So the benefits of a worksheet, now the worksheet is not a required report. It's just a way to look at everything on one screen in Excel, and it helps us in preparing our financial statements. Most companies have a type of accounting software that is used for journaling, posting transactions, creating financial statements, everything. So the steps that we perform on a worksheet are we start with the unadjusted trial balance. Then we post our adjustments, show our adjusted trial balance, then create financial statements, and then compute income or loss and balance our columns. So we can see this example here. We start with our unadjusted trial balance. Then we make our adjustments at the end of the month. That gives us our adjusted trial balance, which then creates our income statement, balance sheet, and statement of retained earnings. That is the end of Chapter 3.